Over the last couple of years, Tesla's revenue growth has essentially flatlined, and its earnings have been sliding downward. Under normal circumstances, investors would flee. Instead, the stock price surged. That surge pushed the company's price-to-earnings ratio to 340. At current performance levels, if you bought a share of Tesla today, it would take roughly 3.5 centuries for the company's profits to cover your purchase price. This creates a stark divide in how the market views the company. One side looks at a traditional automaker that generated $22.4 billion in quarterly revenue, but kept just $477 million in profit. The other side sees a series of futuristic businesses operating under one corporate umbrella. Tesla's valuation is detached from the physical cars it sells today. Instead, the market is pricing the stock as a massive, high-stakes bet on exactly what the company will invent tomorrow. High valuations act like a stopwatch. Investors will bid up a stock while earnings decline, provided they believe massive growth is imminent. We saw the exact same pattern recently with NVIDIA. NVIDIA's price-to-earnings ratio eventually fell because the company delivered the massive earnings per share they promised. The math caught up to the hype. Instead of waiting for profits to catch up, Elon Musk is accelerating the company's spending. Tesla recently announced a plan to spend $25 billion this year alone, a jump of 67% year-over-year in a single quarter. That's an $8.6 billion increase over previous predictions. With the PE ratio at 340 and current earnings still sliding, this $25 billion outlay creates a definitive deadline. All of these brand new projects must begin generating serious revenue before the astronomical cost of building them completely exhaust investor patience. To figure out if Tesla can outrun that $25 billion burn rate, we have to map out their timeline. Elon Musk laid out 5 core growth pillars on his latest earnings call, each with a different path to profitability. The immediate priority, sitting in the 1 to 3 year window, is full self-driving and the robotaxi platform. This moves the business towards selling autonomous software and services. It's a move away from competing strictly on sticker price with EV makers like BYD or GM, aiming instead to compete with Uber through a global autonomous taxi network. The second near-term driver is the Tesla Semi. Trucking relies on the pure math of commercial logistics, where 0 to 60 times and sleek aesthetics mean almost nothing. The goal is to produce 50,000 semi-trucks per year at the Nevada Gigafactory. If the energy economics hold up against diesel, they have a path to capture a massive share of the 13 million commercial trucks in the U.S. Together, autonomy and logistics will prove over the next 3 years whether Tesla's transition beyond a consumer car brand is actually financially viable. Looking out 2 to 5 years, the focus moves toward the massive physical infrastructure projects required for the next phase of growth. This includes the expansion of the energy storage business. Tesla is building megafactories to produce grid-scale batteries, aiming to reshape global electricity grids. Alongside energy storage is TerraFab, a specialized research and manufacturing complex slated to be a $3 billion project in Austin. Musk wants to control the entire semiconductor manufacturing stack in-house, rather than relying on external suppliers like TSMC or Samsung for custom chips. Tesla is vertically integrating the raw power and processing needed to sustain an AI monopoly, building the infrastructure that sits beneath the transportation layer. Finally, at the 5 to 10 year horizon, we find the highest risk element keeping the current valuation afloat: the Optimus humanoid robot. The company is currently designing an initial factory line to build 1 million robots per year, planning to replace the legacy vehicle assembly lines in Fremont to make room for them. While early prototypes can sort objects, making a robot genuinely useful and safe in dynamic human environments requires technological leaps that have yet to be proven at scale. The robotics division acts as the ultimate binary gamble. If they fail, the long-term growth timeline collapses. Success, however, opens a global labor market that justifies the company's current premium price tag. When you look at the $25 billion capital expenditure and map out the timeline, a clear picture emerges. The current stock price requires all 5 of these pillars to execute perfectly. Any delay in software development, any bottleneck in chip manufacturing, or failures in autonomous safety regulations directly threatens the financial structure of the company. We have seen exactly what happens when Tesla's promises hit industrial friction. The Model 3 ramp-up between 2017 and 2019 was marked by constant delays and massive capital burn. That era was turbulent for shareholders. Investors were no longer able to focus on an optimistic story about the future. They had to base their conclusions on the punishing financial data of the present. Analyzing quarterly car deliveries is no longer enough to understand the company's value. The balance sheet is now tethered to the success or failure of these 5 speculative projects. Between now and 2027, the gap between the optimistic story and the real-world financial data will close. If these projects stall, the valuation will likely follow, making the next few years some of the most volatile in Tesla's history.